Welcome to the REI Club at Intel. My name is Daniel Holmlund. Good afternoon, everybody here. So today we unfortunately had our guest speaker cancel. And so I'm going to step in and talk about different real estate strategies, and hopefully we can get a discussion going as a club. I've prepared a couple of surveys just to see what types of real estate investment you are interested in. So hopefully we can go over what these different types of strategies are and see where the interest lies within the club. So I'm sure you'll probably learn something new here. We're going to do a broad survey of a bunch of different types of real estate investing and have a discussion. So I'm trying to share my screen here, and unfortunately Skype is being argumentative about it. There we go. So while we're here, first of all, I want to let you know that we have a number of guests that have lined up. We have a fairly full schedule coming up. There's 6 or 7 currently registered meetups that are happening on Friday in the future. So if you're interested in that, please go to meetup.intel.com and search for REIC, the Real Estate Investment Club. The next thing that I want to show here is our page where we have all of our previously recorded sessions. So here's my screen. So if you're interested in seeing some of our previously recorded sessions, you can go to our Inside Blue page. And yes, for those of you who've been asking for Adrian Gorell's talk, I do have it linked up there now. Unfortunately, Inside Blue, for whatever reason, believes that the file size is too large, and so I just went ahead and put it on a personal Google Drive and dropped the link in here. So while I don't want to make this a common occurrence, a lot of people have been asking for this particular talk, and so it's now available if you go to Inside Blue and look for the document called Links to Recordings and Slide Decks of Previous Guest Speakers. So that's available, as well as Chase Frazier's Mr. House Hack. He's available there as well. And now let me share my screen on my demo computer and go into our talk today. Before I do that, do we have any opens? Are there any outstanding topics that people want to hear about? I'm still on the hook for getting a person to talk about real estate investment trusts, but we actually have several people that are going to be talking about first-time home buyers and programs for first-time home buyers. So expect that in the near future. Does anybody else have any other topics they want to talk about? Could somebody paste the Inside Blue link into the chat for me?
Hey, Daniel. I would be
Yes.
interested to know about what your strategies are with this whole COVID thing. Like, are we expecting a low to come next year around this time? You know, once all the defaults happen, are there going to be a slew of foreclosures? Like, I would like to know, like, what your strategies are
Right.
in the next couple of years, given this COVID thing.
Yeah, and there's a lot of talk and a lot of debate on that. Is there going to be a lot of foreclosures coming up in the future, or and will prices drop because of that, or will the Fed printing large amounts of currency inflate prices again? And there's a lot of back and forth discussion on that. For me personally, I'm still investing in real estate. I do like real estate, and I do have reasons for that, but I know there's a lot of opinions on both sides of that. We at one point had Kathy Fetke on this meetup, and she's well known for being the person who runs the Real Wealth Network, and she's often featured on a lot of the various news channels. So if you're interested in her opinion, she gave a macroeconomic overview right at the beginning of COVID. And so you can check that out on the previous um, recordings page.
So Daniel,
Yes.
hi. Can you hear me okay?
Yes.
Good. So this is Kimberly. So I am a first-time home buyer, and so I would be curious to know what kind of creative yet legal ways I could get into a home with like $1. No,
Okay.
not really $1, but like, what kind of, creative, first-time home buyer investment strategies using, maybe somebody else's money, no money, non-traditional ways to purchase, your first property that would be your residence that, is not really traditional. I'd be curious to see what kind of strategies people may have, but still be legal.
Absolutely. There's plenty of strategies for doing that. You can ask for seller financing. There are a lot of them. And actually, we actually have more people than we really need talking about strategies for first-time home buyers coming up. I put out, an invitation to 5 or 6 people, and I think 5 of them accepted. So we're gonna have quite a few first-time home buyer strategies talks coming up in the very near future here.
Hey,
Okay.
Daniel, so you're sending these to everyone or selective people?
Invitations to speak?
No, I thought you said, long time back you said you're going to start individual groups for first-time home buyer investors. I thought that's what you're saying. Sorry.
Oh, no, well, we were just inviting people to come on and speak. Are you interested in a breakout group?
Yeah, that's what you said. I thought we will get the invite, so that's what I think.
Okay, yeah, for a couple of weeks we did run a Tuesday luncheon. It was basically 11:30 to 12 Pacific time, and it was good. It was decently attended. There were 5 or 6 people there that just came in and chatted about real estate for a while. We can start doing that again on a regular basis, and it's just a time to drop in and talk.
And why I'm saying that, because yesterday we had virtual coffee hours with some random Intel folks.
Mm-hmm.
And it was so amazing to know that 90% of those folks were interested in bringing the topics related to real estate.
Oh, interesting. Which group was this?
It's the ILN.
Okay.
Yeah, so that was good to know that there are so many people interested, so probably.
Okay.
I think it would be nice to have a talk on the other side there where you're into rentals or property rentals and best ways to approach some of that as well.
Okay.
Like management, the pros and cons of different management companies to help you with those rentals and so on and so forth, those pitfalls to try to avoid and stuff like that.
All right, making note of that.
Maybe even in specific Intel Geo related areas versus other locations of advantages, especially relative to, I'm sure there's a lot of state to state and different rules, right, even now. So
Absolutely. Yeah. Yeah, I know several people here in Portland that are fairly active in a governmental level on the rules and regulations for property managers. And I will need people's assistance for places like Folsom and Arizona to find those people. So if you know those people, please, connect us up and we can get some speakers in here that could speak about that.
And I don't, and that's part of the reason why I'm asking to help try to get this group to figure out how to get at or access to more information around that. So.
All right. Any other topics before we get started with today's discussion and talk? One thing I want to point out here is that I have two Bitly links up. One's a survey for what types of real estate strategies you are interested in. I'd love it if you can go there and take that survey. And then the other one is a worksheet which unfortunately last night I spent like an hour making a very nice worksheet for you all and giving it beautiful colors and nice fonts, and then Word promptly crashed and lost it all. So instead it's just typed out questions, and I apologize for that. But grab the worksheet and be looking at it as we go through this talk so that we can narrow in and focus in on what types of investment strategies you're interested in. Was somebody about to talk?
Hey Daniel, I would like to cover if at some point HELOCs and
Great topic.
HELOCs and home equity loans, and see kind of the differences and what the advantages are and how to leverage them to get investments.
Okay. Anybody else?
Also, how to get into bank-owned or auction properties.
Okay. So you want to talk about REOs?
Could you put the links in the chat, since it's a little bit easier to copy paste than to attempt to write that out on a website if you want us to look at it while you're talking?
Yeah. There we go. All right, there you go.
And Daniel, is there, I hear a lot of talk about a formula, but I've never seen one. Do you know if you have any formulas that's used to help determine if you buy property for this, you can get this much rent, and do all this before you actually go out and buy the property?
All right. So a formulaic approach to calculating, say, your return on investment,
Yeah.
or calculating what rent you should be at. What are you looking for? How to determine if a property is worth investing in a particular locale?
That's right, and that way you can understand more about how to get what price range you should be in, and then if you think, well, I should be able to get this rent for that price in that area.
Right. Okay. All right. Anything else before we go into the talk?
Hey, Daniel, can you hear me?
I can.
Can you hear me, Daniel? Okay.
Yes.
So with the interest rates being really low, with people refinancing, have you guys talked about like how to shop around for interest rates, looking at the loan estimates and picking the lender that has the lowest interest rate?
We have not talked about that yet.
Okay.
And
maybe that could be one
I will
suggestion.
put that down on the list.
I second that.
Okay.
I vote another vote towards that.
Excellent.
I have some
same
tips
for
that
me as
I've
well.
learned over time. So maybe eventually, once I put together what I've learned, I can come and share that sometime.
Oh, excellent. Yeah, just so that people know out here, I always love to get guest speakers that are Intel employees. It's always great to hear from one of our own, and I know that there are some people that are very into real estate investing here and all have different experiences. So if you want to speak here, please come forward and let us know. All right, excellent. I've got all those topics down. And one last call for topics before we go into the talk.
Hey, Daniel.
Oh, okay.
This is Reem, but just quickly wanted to maybe if you can have like real estate tips or how to get started for young folks, people in their early 20s, something like that.
Okay. And I would highly recommend you look at last week's talk, House Hacking by Chase Frazier. It was a great talk about how you can buy a house that has an extra room, or maybe buy a duplex or a triplex and live in one side while you rent the other two out, and what exactly that does in order to reduce your expenses and offset your living expenses. So it's a great investment strategy for building up equity and living inexpensively in the meantime, and he did a great job covering it. So
I
that
will check that out.
yeah, that was last week's Chase Frazier on June 19th. Mr. House
Okay.
Hack.
Thank you.
Yes. I can just barely hear you. Okay. Well, if you have other topics, please email them to me. I would love. This is a great list. Thank you so much for sharing and contributing. I love to get feedback to know where people are, and I will look for people that cover these topics. All right. Excuse me. So first of all, in this Ultimate Beginner's Guide to Real Estate Investing, I admittedly did put this together fairly quickly, so maybe saying ultimate is a little bit of an overstatement. But we're going to go through quite a number of real estate investment strategies here, and it's not uncommon for people to ask, what is the real estate strategy that I should use and that I should be looking into as a first-time investor or maybe a first-time home buyer. So before you decide on where you want to plunk down money, you need to take a step back and really assess where you are. There are tons of ways to invest in real estate. And knowing where your starting point is and what you are doing in your life, maybe you are single and you're living with a group of roommates. Maybe I'm getting an IM here. Is this okay? Maybe you're single and you're living with a group of roommates. Maybe you're married and you're just starting off life together, buying a new house together. Maybe you are, midlife and you're looking for a investment property or two, or looking to refinance. There's all different points that you can be along your real estate investment journey. And so getting a good high-level picture of where you are will help assess how much risk you're willing to take on, how aggressive your real estate investing strategy should be, and how much money you can comfortably invest, the types of returns you're looking for, and the time frame that you're aiming for. All of these elements will come in handy as you decide how and when to get started in real estate investing. All right. The next thing you need to do is determine your why. Let's see. Once you determine your why, one of the next things you want to do is decide how hands-on you want to be. And one of the nice things that I like about real estate is that there is a huge spectrum that you can be involved in. You can be entirely hands-on. You can be a fix and flip rehabber that goes in and crawls around and scrubs out mold and avoids rodents while you turn your inexpensively bought house into a piece of art. But you can also be on the other side of that spectrum. You can be someone who wants to be completely passive. Maybe you just want to get the tax benefits of real estate, and you don't want to have to deal with tenants, termites or toilets at all. And so one of the nice things about real estate is that you can really decide how active you want to be. I'm sure you've all seen house flipping shows where they do the whole remake of the house. They go in with sledgehammers and masks and eye masks. And if that excites you, you're probably in the active investor category. And if you want to keep completely away from it, you want to devote time to your job here at Intel, your family at home, and a life outside of Intel, and want to be completely passive, there are strategies for you as well. So we're going to divide up these strategies into how active they are and how passive they are, and talk about them in that sense. And then the next thing we're going to do is we are going to assess your risk tolerance.
And are you going to talk a little bit about how to transition from one to the other? Like maybe you start out as one, but you want to move to the other one. That's
sure. Let's hold that for a question at the end, which probably means I need to go a little faster through the content. But if we don't get to it, bring it up in the Yammer group or the Inside Blue group too. I know there are people that are interested in that. So try to assess your risk tolerance. Every real estate investment, just like stock, every mutual fund, even every time you walk out your door, there's a risk. And as with any investment in real estate, there's a correlation between the risk and the reward. The greater the risk, often the greater the reward. So, for example, in a ground-up development in a transitioning neighborhood, you might have a higher level of risk. Whereas in an existing building or structure where the rents are well known and the mortgage and expenses are well known, you might have a lower risk. So being able to understand what those risks are and being able to quantify them is good. That's why I like the ideas here of how to compare a loan, because knowing what your loan rates are obviously is key in knowing what your expenses are. How to understand what your return on investment is key to knowing whether you should purchase a property or not. And then next, determine how much you want to invest. So one of the other ways that we're going to divide up these strategies is strategies that don't require a lot of capital, and strategies actually that have a mid-tier, say you have enough capital to make a down payment on a home. And then there's strategies that are more expensive, where you have to put in a larger chunk of cash in order to participate in the real estate deal. So we'll divide them up into kind of a high, medium, low category and go through each of them. All right. Next is the fun part. I hope you've been able to grab that worksheet, and I hope you've taken the survey. So we have two surveys actually in this. The first one is before the talk starts, so take it right now. And the next one is after the talk. So I want to see if anything in this talk has shifted your thinking about how you want to invest in real estate. So let's get right into it. Single-family homes. So single-family homes are perhaps the most tried and true investment in all of history. People have been renting homes for thousands of years, and it's something that is extremely common. It's the most tried real estate investment of all time. What do you usually get in these? So there's a couple of different ways you can do this. One of the most common ones is turnkey rental. And turnkey rental is a strategy where you look for a house that is already entirely fixed up. You're looking to buy an investment that has a stream of income associated with it. That income usually is monthly and reoccurring, and somebody else is managing it for you. So there's a lot of turnkey home providers that are out there. We had Marshall Reddick, which is just one turnkey home provider. I happen to have liked their webpage because they had a lot of very nice calculators on their webpage that would give you good indications of what your ROI might be on a particular investment. So that's marshallreddick.com if you're looking for them. But they, like many other providers that are out there, they find homes. They usually will fix them up or basically make them rent ready. And then they search for people that are willing to put their investment there. These people are looking for a low to medium level of effort. And so they will sell you the house, and then usually they will sell you the management services that go along with it. Management services on a single-family home often run around 10% of your monthly income. And I apologize if I encourage you to type in the chat window, but I'm not going to be able to look at it while I'm giving the talk. So if other people want to respond, please go ahead and do so. I'll look at it as soon as we get to the questions time. Cash flow, these are all, of course, up for debate. Your cash flow can vary quite a bit depending on how you buy it, what the condition of the market is in those areas. But I'm trying to give kind of a ballpark example here, and I'm sure there are people out there that will debate me on these. There are definitely single-family homes out there where, for instance, if you put down a down payment of 50% of the property value, well, then obviously your cash flow is going to be much higher. But on a typical 20% down, your cash flow after property management expenses have been taken out are going to be somewhat lower. So 5 to 8% on these. Of course, you're paying down the loan. So the renters that are in there are paying off the property on your behalf. With the way that inflation is going right now, the dollar amount that your loan is worth is usually getting smaller over time. And so we're also seeing a fair amount of asset appreciation due to the inflation as well. So hands-on effort. This is a low hands-on effort. Medium risk, you are ultimately the owner, so you do have responsibility for everything that goes on in that area. You have to manage the property managers, so they'll call you every once in a while and let you know, hey, the toilet is running, or the air conditioner went out, or there needs to be a pest control person sent in. Whatever that happens to be, you do have some risk associated with it. Of course, that can be offset with insurance, which you absolutely should carry on your single-family home. Cash to get started is you have to buy the home, so you have to put down a down payment. The hold period is whatever you decide. This investment is open to non-accredited investors. You don't have to be accredited to buy a house or an investment property. And it is tax advantaged. So I have a slide later on that brings out the differences between tax-advantaged real estate strategies and non-tax-advantaged. A basic rule of thumb is that if you've ever read Tom Wheelwright's books, he does a lot of real estate CPA and tax accounting type books. He's a member of Robert Kiyosaki's group, and he's got a series of books out that talk about minimizing your taxes. And one of the things that he really pounds home is that the tax code is simply an incentive structure. And the government, ideally, the government incentivizes some behaviors and discourages other behaviors. And one of the behaviors they incentivize is improving properties and renting them out over a long-term period. So any investment strategy where you have a long-term hold, or you've improved the property and are renting it out, that will tend to be a tax-advantaged situation where you can, for instance, deduct mortgage interest if you're living in it, or deduct depreciation on it. There are even cost segregation studies that you can do on, usually not a single-family home, that's usually for a slightly larger building. But there's definitely depreciation and other types of tax write-offs that you can take that make single-family homes a tax-advantaged investment strategy. Next, fix and flip. So fix and flip is where you get a lot of the television shows that show these dilapidated houses and how they've been turned around into something that's brand new and beautiful. You can often get a very large ROI on these types of deals. And I have an example here on the next page. The ROI is the key thing that makes this an attractive strategy. There's no cash flow that's associated with it. So in this particular strategy, you would find a house. Let's say that it's worth $114,000. Actually, I'll just go down here to, oh, I don't have my example next. But let's say you find a house, you put 20% down, or maybe the house is in such a poor condition that you can't get a loan on it. So in that particular case, you may have to put more down and just buy the house outright. So you have to acquire the house. You then have to have a rental rehab budget. And you either, if you're a hands-on person, you might be the one fixing it up. Or if you want to go a more scalable route, you may hire people to fix it out. Of course, that'll increase your rehab budget. So you have to be careful about cost overruns and project overruns, things like that. Cash flow on this, while you're holding the house and fixing it up, nobody's living in it. So you have no cash flow. On the other hand, there's a fairly high amount of effort that goes into it. There's a high amount of risk that goes into it. A lot of people that try this strategy lose money, several times, or just barely break even. Coming up soon, I think in 5 weeks or so, we have a lady who runs a real estate investment club in Seattle. Her name is Leica Deptha, and she's flipped over 40 houses in Seattle, and she's going to come in and share extensively about her home flipping experience in Seattle. All right. Of course, you decide how long you hold it. The point of this particular investment strategy is the velocity of money. And so the faster you can flip it, the better. It's open to non-accredited investors, of course. And is it tax advantaged? No, not really. So your profit that you make from this particular strategy is either going to be taxed at regular income rates if you've held it for a short period of time, or perhaps capital gains. But it's taxed at the normal income rate. All right, short-term rentals. Short-term rentals. With short-term rentals, you buy the property, you hire a property management company that specializes in short-term rentals, or you possibly do it yourself. But in this particular scenario, you are renting out the building for short periods of time at a higher rate of return. And the amount of revenue that you make from this is going to be very dependent on the location, how attractive it is for people to rent it out, and just how many people and how often you have it rented out. So the cash flow is very variable in this particular scenario, but it can be quite a bit higher than a single family home. It has a hands-on effort. So you're constantly talking to the property management group who is cleaning it up and getting it ready for the next group. There's a fair amount of risk, and the reason why I rated this high was because the occupancy or the vacancy, whichever way you want to look at it, can be very variable. You decide how long you own it. It's open to non-accredited investors. And is it tax advantaged? Well, perhaps you do usually own the building. You do get depreciation and write-offs. There are potentially a lot of hotel and short-term rental taxes that have been cropping up in various locales. So there's a fair amount of legal risk currently within this particular investment strategy. There are more and more locations which are putting extra regulations and extra taxes on short-term rentals. Real estate investment trusts. So real estate investment trusts, were popularized by Sam Zell. Sam Zell is a Chicago investor who is responsible for equity residential and a lot of large real estate groups. He was very instrumental in popularizing the real estate investment trust. And basically the reason why he did it was because there were properties to be bought and not enough money to buy them with. And so he needed to find a way of securitizing them, dividing them up into securities, and raising equity from the public. And so the real estate investment trust was really pushed for by Sam Zell and others. Real estate investment trusts are trusts that hold potentially a variety of real estate, or they might just focus on one particular sector within real estate. They tend to have slightly higher ROIs. One of the main reasons that you would hold real estate investment trusts is for the dividend income. Dividend income can be 4 to 10%. It can be a fairly steady way of getting rental income, or income rather. Hands-on effort. This is extremely low. It's like any stock. You buy it and you sit back and you let dividends come in and you watch the appreciation go up and down. Cash to get started, it's very low. You can buy them just like stocks of shares of stock. Holding period, it's a liquid investment, so there's a market for REITs. You can go in publicly, and they're traded on the public exchanges. Are they open to non-accredited investors? Yes. Are they tax advantaged? No, not really. Income from real estate investment trusts are taxed at normal taxation rates. So it's either capital gains or income tax rates.
Can you do the REITs inside a self-directed IRA and get the advantage, or is that not possible?
No, absolutely. You can, if you have a self-directed IRA, you can invest it in REITs or any type of real estate investment. Just about. There are rules around it, such as not benefiting yourself directly or your parents, right, or your children. So there are rules around it. But yeah, you can hold a REIT inside your self-directed retirement account. I'm reading a book right now on QRPs, qualified retirement plans, and it's really fascinating. I'm just diving into that topic myself.
Sorry, I'll hold my questions till later.
Oh, no problem. Yeah, I'm rushing to get through this. I apologize for that. Okay, real estate syndication passive. So real estate syndication, what syndication is it's basically a way of raising funds in order to buy a larger piece of real estate. So in a syndication, you have a group of people that are coming together in order to purchase an asset which might have greater economies of scale and also have greater returns. So in the case of real estate syndication, you'll often hear about apartments being syndicated. You'll hear about office parks being syndicated, medical parks being syndicated, potentially mobile home parks being syndicated. But basically, what it means is that there is one group of people that are the managers, and they're the hands-on active investors. They are responsible for finding the property, for acquiring the property, for putting it under contract, for putting together the renovation plan if there's a renovation plan. And then there's the limited partners who are they provide the capital to purchase the project. So real estate syndication is for passive people, it is a truly passive way to invest in real estate, because you, as the capital contributor, you have a limited liability, hence being a limited partner, meaning you can only lose up to what you put into the investment, but it is a group investment. So oftentimes you'll have, a couple of dozen people pool their money together, purchase a large apartment complex, for instance, in this case, and then have the active investors execute a renovation plan that returns an investment, gives an investment on return to all the investors. The ROIs for this right now, as some of you know, I'm fairly active in this type of real estate investment. This is my preferred style of real estate investment. And if you're interested in, please contact me about it. I love to talk to people about it. But annual ROIs tend to be about the lowest that I would accept is a 15% ROI. A lot of them do tend to hover around 15% because many of these groups want to under-promise and over-perform. So even if there's room in the business plan, a lot of times they'll say, okay, 15% is around our target, and if we over-perform, we can delight our investors. The cash flow is usually 7 to 8%. In the case of a real estate syndication, there's something called a preferred return. The preferred return means that the limited partners get, in this case on the slide, 8%. The first 8% of the income that comes in goes to the limited partners before the general partnership gets anything. And the reason for that is that it incentivizes the general partnership to make the property perform at over the 8% preferred return. Once it performs over that, then the general partnership shares in the returns. And that split is often like an 80-20 or a 70-30 split. For the passive investor, it is entirely hands-off. The only thing you need to do is identify the group and the investment and decide to invest or not. But once you have invested, there is nothing to do other than to receive updates and receive checks. The cash required to start is, most syndications that I've seen are around 50 to 75K. There are some that go down to 25K. Many of them go much higher. Many of them start at $100,000 or $200,000 for an initial investment. The hold period is 3 to 6 years. And this is dictated by the length of commercial loans. Commercial loans are often 7 to 10 years. And so the target here is to add value to the property and to refinance and then sell the property within that commercial loan time period. So you'll see a lot of 3 to 6 year holds. This also means that real estate syndications are not a liquid investment. And being not a liquid investment means that you have to be comfortable with being invested for 3 to 6 years. And you, of course, don't want to, invest your last dollar in a deal like this. This is something you need to understand is going to be illiquid. So is this open to non-accredited investors? Sometimes. There's two types of syndications. One's called a 506B. The other one's called a 506C. 506Cs are only available to accredited investors. And the general management is allowed to publicly advertise them. With the 506C, 506Cs are a section of the SEC code that allows you to exempt yourself from a lot of the registration that you need to do. But in order to exempt yourself, you have to meet certain criteria. And one of those criteria is that you are not allowed to publicly advertise these deals. So a 506B is allowed to take up to 35 non-accredited investors and an unlimited number of accredited investors. Is it tax advantaged? This is the tax advantages in real estate syndications are incredible. Just to give you some numbers, my very first syndication that I did as a limited partner was a 56 unit down in Pasadena, the southeast suburb of Houston, Texas. And it was a Class C apartment, so working class apartment. We did a renovation on it. I put 75,000 into it. On my very first year, on my partnership return, I got a K1 form that said, due to accelerated depreciation, you have a negative 51% income investment write-off. So negative 51,000 is what I got. So on a 75,000 down, I got a write-off of 51,000 in the first year. And I was making this 8% coupon, so I was getting $6,000 per year divided up over 12, so $500 a month is what I currently am getting on this. They actually moved it to a quarterly schedule, so it's $1,500 every quarter. But I can take that 51,000 and use it to offset the income that I get. Since I'm only getting 6,000 in the first year and I've got 51,000 of depreciation, I'm getting this investment entirely tax-free, plus the extra rolls over to the next year. So for most likely for the lifetime of this investment, it will be tax-free. So great tax advantages with this. You get the same.
Daniel?
Yeah.
Sorry. Quick question. Oh, you know what? Maybe this question might answer this next section. With the syndication for the passive, you mentioned that the apartments are already built.
Yes.
What if collectively you wanted to build an apartment community?
Yeah, there's the numbers are similar, but it's almost when you look at the underwriting for a ground up development versus a value add plan, it's similar, but at the same time, it's almost like you took French and now you're trying to speak to someone who speaks Spanish. It's you sort of understand it. Basically, in a ground-up development, obviously, people aren't going to be living there for the 2 to 3 years that it takes to construct the property.
Oh, right.
Whereas with a value add, people are there. So with a value add deal, you come in, you renovate the units, and you improve them, and you see a quicker return on investment. So limited partners are paid faster, or earlier, rather, I should say, than a ground-up development. Ground-up developments tend to have higher overall average returns. You're looking, 20 to 30% oftentimes with these types of developments, but you don't see any cash flow for the first couple of years, and it's often a longer hold. So you might be looking at 5 to 10 year hold.
Okay.
So that's a really quick summary on the two of them. There are other subtle differences too.
Okay, thank you.
I have one more question.
Yeah.
So you said that the property depreciated in first year, but it could have been appreciated later on, right? So still, why is the return, like the 8% return, tax free throughout the rest of the property investment?
So the accelerated bonus depreciation came about as part of the most recent tax cut bill in 2017. So it's all part of the tax code that you can accelerate parts of the depreciation. Now that depreciation can be recaptured also at sales time. So some of that depreciation that you get in the initial part of the investment will be recaptured at the end of the investment, but it's usually not a one-to-one recapture rate, and it depends on your particular situation. So it's part of the tax code that you can accelerate your depreciation. Does that answer your question?
Yeah, so that's why the 8% investment is tax-free, because it's part of the depreciation.
Yeah, the depreciation will offset the income tax from that 8%. Yeah.
Got it. Yeah, thanks.
Okay. As an active real estate syndicator, this is what I am. I am an active real estate syndicator. It's a high hands-on effort. You have to find the property, work with partners in order to renovate the property, You go through the entire life cycle of the property, update and manage investors on that property, update and manage tenants on the property, and then look to sell or make a disposition of that property. Your annual return is usually a little bit higher than the passive investors because you're putting in sweat equity. So it's around 20 to 25% ballparking. The cash flow is actually very low because cash flow tends to go to the limited investors before the general partnership because you want to keep them happy, basically. Effort is higher. The risk is higher. The limited partners have a limited risk, whereas the general partners have an unlimited risk. If something goes wrong with the property, or if there is any sort of lawsuit put against it, the general partners are the ones that bear the brunt of that risk. Cash required to start. It's about the same as the limited investors. It is possible legally to start with zero cash doing this and have your contribution be entirely sweat equity, but I would never invest in a real estate syndication in which the partner's not putting their own money in. So you should always look for that as part of the deal. The hold period is exactly the same amount of time. Is it open to non-accredited investors? It can be, but usually particularly the people that are giving you the loan want to see that you have a net worth that's able to cover the loan. And so usually the people that are signing on the loan have to have a combined net worth to be able to do that. And that is often a subset of the general partnership. So it's possible to be in there and not being credited, but oftentimes most of them are. Is it tax advantaged? Yes, it shares the exact same advantages as passive. All right, the BRRRR strategy. And I know I'm probably...
Just one question on the active.
Yeah.
In that instance, could you take the depreciation and the actual losses in the year versus accruing them in the property? Are there no income thresholds for that like there are with passive loss activities?
Yeah, the tax benefits are exactly the same for the general partnership and the limited partnership. The LLC, which holds the property, is a pass-through entity, and so it's all reported at the level of the partner rather than at the level of the LLC. Does that answer your question, or did I?
I think so. It gets more into passive versus active loss activities, which you treat those differently under certain income thresholds.
Mm-hmm.
Okay, but I'll follow up offline.
Okay. All right. The BRRRR strategy. So the BRRRR strategy is the buy, rehab, rent, refinance, and repeat strategy. This is where you find a house that is a fixer-upper. You fix it up, and then instead of selling it, you keep it as a rental home. This is actually a tax advantage strategy because the government incentivizes you to fix and keep long-term income property. It's providing a public service to do so. It's open to non-accredited investors. Just like any rental home, you can decide how long you want to hold it. Usually, you need to have at least a down payment, or if the house is in a poor enough condition that a bank won't loan on it, you may have to either use seller financing or just buy it outright with cash. So the annual ROI can be quite a bit higher because usually you'll buy it for a lower price and then you will fix it up and rent it out, and you'll have a good amount of equity in the home and be able to rent it at a higher rate. So it's possible for you to get a larger amount of cash flow in a deal like this. Okay. I'm going to skip the example. I'll leave it in there. So if you want to look at the presentation, you can see it. But I'm going to finish off the last few here really quickly and then go to a question time. Wholesaling. Okay, now we're getting into our options for people who have very low amount or little money that they can put into a deal. Wholesaling is the idea that you go out and find a person that wants to sell a house, you put it under contract, you then go and assign that contract to another person who will market the property and sell it. So the service that you are offering to the market is you're going out and finding distressed properties and making them known to a network of people that wants to sell them. So the idea here is it's transaction-based, the ROI. Cash flow, there's no cash flow involved in this because you're not collecting the rents. What you are doing, though, is you are putting a house under contract and then trying to find somebody who wants to execute that contract. So you may put no money down and just say, hey, I want to be able to buy this house at this price, and then you take that contract and you sell it to somebody else who says, well, I can sell it for 10,000 more than you put it under the contract for, and so you ask for a middleman cut. Is this tax advantaged? No, it's not a long-term investment strategy. So you are taxed at regular and ordinary income rates, capital gains and income, and anyone can do this. It doesn't have to be accredited investors. Office and medical parks, go through this really quickly. If you're interested in this, go back to Bob Bowman, who spoke, I believe, 3 weeks ago. He's very, very into investing in commercial office parks and goes through the underwriting quite extensively. But oftentimes you get a pretty good return on investment. The cash flow tends to be lower. Hands-on effort, if you're the active partner, is high. If you're a passive partner, of course, it's low. Risk, I put medium here just because the risk can often be sector-based. If you've got a medical park, if you've got a retail park, and suddenly nobody's going to stores, then obviously there's a lot of risk there. Cash required to start, it's usually more than...
Daniel?
Yes.
Sorry, is there a slide you're showing? Because you're still on wholesaling if there's a slide.
Uh-oh. It stopped, huh? Okay. Thank you for letting me know. It's asking me how the quality of the call was. I'm going to have to say poor.
Oh, okay. Well, continue on.
Yeah, let me try and reshare the screen here. It's not letting me reshare my screen. Here we go. My apologies. Why don't we just go to questions for the moment while I try and fix this?
Keep going.
Daniel, I have a question.
Yeah.
Your ROI and cash flow, was this pre-COVID estimates, I'm guessing?
Yeah, it's assuming normal business activity. There have been a lot of interesting things that have gone on during COVID. So lenders have tightened requirements. So, for instance, if you're getting a loan, initially at the beginning of COVID, the Fed came out and lowered interest rates to 0. And there was a flood of people that were refinancing. And so in order to slow that down, banks actually raised their rates. And so for a while, rates actually went up in the middle of COVID. And now that the flood of people refinancing is starting to slow down, rates are coming back down from the bank to customer relationship point of view. So there's been lending restrictions that have gone on. Of course, people are getting a lot of supplemental assistance from the government. So there's worry about, will that continue and will that run out? It's hard to project those sorts of things. But lenders do have options. Landlords have options. There's options in terms of forbearance and other activities that are going on. I need to mute here and reshare my screen. Let me know if you can see this now. Oh, not that. This. Can you see that?
We are still on wholesaling lease options, but I think you could just continue, I guess, your conversation.
Yeah, I don't know why it's not sharing anymore. But let's go to questions. The other strategies that I have listed on it are residential tax liens and then mortgage and private note investments. And so if you have questions about those, we can talk about that also.
So I have a question, Daniel. I'd never heard of the real estate syndication stuff before, and it sounds like that's something you're doing, but the buy-in on that is kind of high. So I'm wondering, did you start there, or did you start somewhere else and work your way up to that with other options that maybe had more cash flow? What was your evolution on that?
It's my evolution specifically with that is that I started as a limited investor. And I invested $75,000 in my first deal, and I've been doing $50,000 in others. So I did start with that and learn the business really well, and then I moved on to being an active participant there. Back starting as early as 2002, I did do a fair amount of single family home rentals. So I've been doing that for quite a while. And then after 2008, I took a little break. Actually, I turned out okay going through that time, but it was a rough period. And around 2015 or so, I discovered real estate syndications, and I think they're very scalable and they've got great tax advantages. So that's my evolution on it.
Are there BKMs you have for the passive real estate syndication? That how do you go shop for those deals, or what do you have to look out for, and things like that?
Yeah, so the BKMs are that the SEC requires people that are involved in real estate syndications to get to know their investors and to have a relationship established with them. So if you're interested in those, you have to reach out to real estate syndicators and talk to them about what they do. And I'll just put that out there. If anybody wants to talk to me, I'm very open to that. I'm always looking for investors, obviously. But the SEC does not allow you to publicly advertise your deals. And so you have to find people. You have to look at their track record. You have to make a decision about whether you trust them or not and how they're executing. And there's a lot of different syndicators out there. And so you can get a variety of experiences. And some, usually they will focus in one particular area. So another thing you have to look at is, do you like the area that they're focusing in? So those are some of the basics. There's a fair amount of learning to do. And if you just look up real estate syndication, there are a lot of articles out there about it.
Thank you.
A question about that. You mentioned investor accreditation. Did you start being an accredited investor, or did you start as being non-accredited and became accredited so you could do active? What was that like?
Yeah, I started as non-accredited, and at some point along the line, I passed. So to be an accredited investor, accreditation is a term that the SEC uses in order to qualify your investment, quote, sophistication. And the qualification to be an accredited investor is just that as an individual, you make $200,000 or more. As a couple, you make $300,000 or more, or you have a net worth of over $1 million, not including your primary residence. So those are the qualifications. If you meet those qualifications, the SEC has dramatically lower reporting requirements for working with investors that meet those criteria. So that's why the SEC requires syndications to track the accreditation status of the people that they're working with. So yeah, I mean, at some point along the line there, I wasn't, and then I was. Any other questions?
Hey, hi, Daniel. Hi. I wanted to know, have you done any lease-to-own options, and if so, what are some things to look out for?
I haven't, but I love it as a strategy. It was actually right there on the wholesaling and lease option slide number 18. So lease options are contracts that you can put down and say, I would like to have the right to purchase your house at a certain price. And then oftentimes what investors will do, let's say that you have a house and you want the right to purchase it at $100,000. And you think you can turn around and sell it at $120,000. So you'll put it under option, and then you'll go out and do the marketing in order to market it, and then sell it at the higher price. There are other advanced strategies too. For instance, you can buy it at a certain price, and then rent it out. Say you have an option with the right to purchase. So oftentimes there are advanced option strategies where you can put a renter in the house, and you are paying the owner for the house and collecting from the renter, and so you've put yourself together as a middleman in the rent spread. So let's say the renter is paying $1,000 and you pay the owner $800 and you take the spread, and then eventually sell the house to the people that are living in it. So
you're making a passive income while also being given the option to sell it at a premium.
Exactly. Yeah, it's a great strategy. The thing that you need to have in order to build up a lease option business is you need to have great marketing skills. You need to, oh, it's 1 o'clock. It's a great strategy, and I'll get someone in here to talk about it.
All right, thank you.
Any other last minute questions? All right, I hope you guys have a great weekend. Thanks for listening.
Thank you, Daniel. This was awesome.
Yeah. I wish
and take the survey. Take the survey at the end. I'll email it out to everyone.
Right.
All right, thank you.
Okay. Bye.
Thank you.